Thank you, Ty. Thanks for that introduction. And I want to thank Lisa and Jonathan for inviting me here to speak. And Danny's gone, but it's nice to be here at the end of his reign with ALEC and the beginning of Ty's. Now, since 2018, let me get organized here. Since 2018, and more openly over the past 2 years, we've been all dealing with an insidious neo-Marxist investment strategy known as ESG investing. Now, my starting this talk with a phrase like neo-Marxist may have surprised you, but I believe we need to call it what it is. Elon Musk calls it communism rebranded. He also called it the devil incarnate, and he's dramatic, and if you saw his comments yesterday, you know he's dramatic. But he's not necessarily wrong. So let's take a deep dive on what ESG actually is, how it impacts our free market economy, how the firms that manage your state's monies, for those of you who are legislators, how they get away with putting ESG considerations over the financial interests of your constituents, and why ALEC's fiduciary duty model legislation is so very important. Now, while everyone here today knows what ESG stands for, environmental, social, and governance, just 2 years ago, very few people knew even that. Of course, that was the intent. ESG was designed as an innocent-sounding ruse to conceal what it really meant for American businesses. That's part of the reason it took so long to figure out what financial firms and their CEOs, such as Larry Fink, were actually up to. In reality, ESG is socialism in sheep's clothing. It empowers a class of financial elites to make economic decisions for us. It creates a shortcut around the ballot box to coerce the CEOs of American companies to implement a progressive policy agenda and put that agenda above their obligation to generate returns for investors. It accomplishes this goal by empowering an elite group of financial managers who invest other people's money so they can use those monies to advance a collectivist political agenda. Even today, few people really understand the extent to which ESG has permeated all of our lives. And again, that's intentional, and due in part to the fact that the left is really good at doing things surreptitiously. Even what they call themselves keeps changing as people figure out what they actually support. Marxists, communists, socialists, progressives, globalists, they all refer to essentially the same thing: a collectivist mentality that diminishes us as individuals and enhances the power of a group of elites. They just change the name whenever people actually figure out what they're up to. So let's talk about surreptitious. ESG doesn't even have a definition. There isn't even anything accepted where you can go and look and see what ESG includes. It simply includes any political agenda items that progressives, as they most commonly call themselves today, wanted to include. Now, we all know it at least includes radical environmental policies. This is the big one, the E in ESG. Klaus Schwab's and the World Economic Forum's net zero by 2050 emissions goals that would destroy our economy, if not the global economy, as current events continue to demonstrate, driving people into poverty and increasing human suffering. The S in ESG is synonymous with DEI, or diversity, equity, and inclusion, another innocuous-sounding ruse that's permeated America's corporate culture. Now, I'm going to use the term ESG in this talk, but the S, it is synonymous with the acronym DEI, which includes, for example, critical race theory human resource training, teaching employees that they're either victims or oppressors based solely on their race or their sex. Now, why would any rational employer teach employees that they're victims and being oppressed by other employees based solely on their race or their sex? That's something they can't even change. That hardly promotes the teamwork that's essential to running a successful business, which leads to the G, or the governance part of ESG. The G includes discriminatory board appointments, where you put people on your board of directors based on their race or their sex rather than their qualifications, merit, or character. Now, that's something I've been fighting my entire professional career. As many of you know, Martin Luther King, back in the early 1960s, said that he looked forward to a day when people would be judged on the content of their character, not the color of their skin. Well, here we are 60 years later, thanks to ESG, making decisions based on the color of a person's skin rather than the content of their character. And that seems to be the in thing to do in corporate America. And that's just a few of the policies that ESG has been employed to advance, all with the thin veneer of leftist morality and collective action. We could also discuss things like Black Lives Matter, promoting abortion at the corporate level, really anything that the left wants to promote, it promotes through ESG. But the most important point about ESG is that it transcends specific issues. It's whatever the current guardians of leftist morality say that it is. So let's talk about what ESG is at its core, which is much more important than any particular issue. At its core, ESG is a rejection of our founding principles and our Judeo-Christian values. It undermines representative democracy, it undermines our economic freedom, and it undermines our individual liberty. It threatens our democracy because it's a shortcut around the ballot box that these massive financial firms use to implement leftist policies that simply lack popular support. It threatens our economic freedom because they use their massive shareholdings to compel the CEOs of the companies in which they invest to put these policies above their obligation to generate returns for shareholders or profits. And it threatens our individual liberty because they use our money to do it. Our 401k plans, our savings, our pension funds, and very likely the pension funds, many state funds for many of the states which you represent. It's a tool to empower corporate and government elites to use the American private sector as a means to avoid the inconvenience and messiness they see with our representative democracy and our free market economy. They prefer to have corporate elites set our nation's policies. In other words, them, not us, because they don't trust us to make decisions, the best decisions for ourselves, our nation, or our planet. And at the heart of their effort to advance this ESG agenda is the villainization of profit as an oppressive force that drives poverty, inequality, and if you believe the rhetoric, threatens the very existence of our planet. But what they're really attacking is the notion unique to free market capitalism that you can improve your life through your own efforts. You can profit through your own efforts. President Reagan believed that the concepts of profit and freedom were inextricably inseparable. And as usual, he was correct. It's the profit motive, the fact that everybody has the freedom and the opportunity to better their lives, that drives our great engine of economic prosperity. The left knows that profit is the heart and soul of free market capitalism. So the profit motive is their target, their enemy, their villain, the villain they would destroy or defeat. To do so, they attempt to reorient modern corporations so that rather than focusing on profits or shareholder returns, they focus on advancing leftist political goals, which they frame as efforts to save the world. Now, some of you may say, well, maybe not this group, but there may be groups that would say, and maybe you know people who would say, isn't that a good thing? Isn't there too much poverty, too much inequality, too much carbon? And what's so great about capitalism? Isn't it better if companies pursue these social and political goals rather than profits? Won't that result in a better world? Of course, the simple answer is no, it won't result in a better world. In fact, the profit motive has proven to be the only effective driver of global prosperity. It's moral and its impact is benevolent. Now, that certainly isn't what you're going to read in the New York Times, but I believe it's an indisputable fact, one of many that the New York Times gets wrong. Why? Well, as I hope everyone in this group knows, or at least intuits, in a free market economy, businesses profit only by meeting the needs of others. Capitalism encourages people to improve their lives by providing the products or services that others want at a price they can afford. In this sense, businesses striving for profits benefit other people and society as a whole. Now, that's more altruistic than it is greedy. When I was the CEO of CKE Restaurants, we spent literally millions of dollars every year trying to figure out what consumers wanted. What kind of burgers did you want, and how could we offer them to you at a price you could afford? Under capitalism, knowing what your customer wants and offering it at an affordable price is not only the key to success, it's the key to survival. Under capitalism, we've got a form literally of economic democracy where consumers vote. You vote with every dollar you spend, determining which companies, which businesses succeed and which fail. Consumers have the economic power, not government or corporate elites, because it isn't government or corporate elites that decide what businesses must do to succeed or fail. It's consumers. Capitalism empowers the common man and the common woman because every business needs their votes for its success. And they compete for that vote, trying to provide the most benefit to the broadest number of people. Now, that may not be truly altruistic conduct, since capitalism does depend on our natural desire to better our lives, but it channels that natural desire into focusing on the needs of others. You improve your life by satisfying other people's needs. I mean, it's a heck of a motivator if you think about it. Henry Ford built cars for the common man and the common woman, not kings, queens, and nobility of his day. Steve Jobs came up with the iPhone, or the idea of a smartphone, for all of us, not for government or corporate elites. And Jeff Bezos, he became tremendously wealthy, often criticized for it, but he became tremendously wealthy because he provided us with tremendous benefits. He created the greatest distribution system in the history of the world. Now, none of these individuals became wealthy because they stole from us. They became tremendously wealthy because they provided us with tremendous benefits. From Ford to Bezos and Musk to the family that runs your local pizza joint or burger joint. In a free market economy, we benefit to the extent we benefit others. So throughout our history as a nation, self-made men and women, free from government interference, have forged ahead with innovative ideas and solutions that created jobs, wealth, and prosperity, not only for themselves, but for the entire nation. They improved their fortunes and, in the process, the lives of their fellow citizens and the human condition. Now, nonetheless, some of you may still wonder, come on, Andy, does free market capitalism really improve the lives of ordinary people? Or is it just improving the lives of the ultra-wealthy, the Fords, the Bezoses, the Musks? So I'm here to confirm, in fact, capitalism, free markets, driven by the profit motive, have produced the greatest wealth in human history, lifting billions of people out of poverty worldwide. And you don't have to take my word for it. Even President Obama stated at Georgetown University in 2015 that, quote, "We don't dispute that the free market is the greatest producer of wealth in history. It has lifted billions of people out of poverty." And he was right, and that's not something I say about him a lot. Here's a graph that proves it. This chart, oops, back one. Come on, go back. There we go. This chart takes data going back to 1820, when capitalism began its rise. The blue line is based on data from an economist named Angus Madison, an English economist, who tracked the historic growth of GDP per capita, or economic growth per person, worldwide. The red line is from World Bank data, also going back to 1820, and showing the percentage of people that were living in extreme poverty throughout that period of time. So two different data sources. And as you can see, they move in tandem. As GDP per capita increased, people living in extreme poverty decreased. And it wasn't just the wealthy who saw benefits. 90% of the world's population was living in extreme poverty in 1820. If you add in just regular poverty, it goes up to 94%. And that had been true for millennia. Today, the number's under 10%. It actually got down to about 8% pre-pandemic and is heading back down to 8% now that we're post-pandemic. This is the benevolence and the power of free market capitalism. And free market capitalism works because people are free to focus on generating profits. The greater the potential for profit, the greater the risks people are willing to take, the greater the investments people are willing to make, and the greater the associated economic growth, all resulting in broad-based prosperity and the greatest reduction in human suffering and extreme poverty in history. Now, all this tremendous energy is generated by the profit motive, people striving to meet other people's needs as the key to improving their lives. It's an incredible energy. To the extent we allow ESG to reorient modern businesses toward accomplishing social or political objectives rather than making a profit, we place the tremendous benefits of this profit-based system at risk. Now, what sane person would want that? Like, why endanger a system that has created unprecedented human prosperity, lifting billions of people out of poverty, reducing human suffering to its lowest level ever, as even someone as far left as President Obama has had to acknowledge? Well, the answer is a familiar refrain throughout the history of socialism. Rather than empowering the common man and common woman with economic power, ESG empowers a class of elites who believe they can manage our lives better than we can. It's about exerting power over people, not transferring it, and then transferring it to the collectivist elites, as Margaret Thatcher, Ronald Reagan's good friend, showed back in the 1980s. And everywhere and every time these collectivist policies have been tried, socialism, communism, whatever you want to call it, whatever they want to call it, it has failed. You know, think about the former Soviet Union, Cuba, Venezuela, North Korea, or China before red capitalism. Socialism's one predominant feature is failure. So given socialism's dismal history and the benevolence of capitalism, how in a relatively short period of time did ESG proponents gain such incredible momentum, virtually turning corporate America on its head? Well, the ESG era began in this sad collectivist history back in 2018, when BlackRock CEO Larry Fink sent his annual letter to CEOs titled "A Sense of Purpose." As you all likely know, Fink sends an annual letter to CEOs telling them what he expects from them in the coming year. It's almost like he thinks he's their boss. At first, Fink's letter talked about what he and BlackRock were seeing that the CEOs of the companies in which BlackRock invested might find useful in the coming year when they were running the companies that they manage. Nothing wrong with that. In 2018, that changed, and it changed dramatically. Fink's 2018 letters to CEOs was a stunning exercise of raw financial power. It directed America's CEOs to turn their businesses from engines of economic production into drivers of progressive social policy goals. According to Fink's 2018 letter, our society, not Fink, mind you, our society, was demanding that companies now serve a social purpose, and that going forward, every company must show how it made a positive contribution to society. Now, that was a monumental change. The leftist media touted Fink's letter as a direct rebuttal to Milton Friedman, who wrote in a great and influential New York Times piece in 1970 that the social responsibility of business is to increase profits. If you haven't seen that 1970 op-ed, pull it up. It's really, really excellently done. Bloomberg, when Fink's letter came out, claimed that Fink's letter had the effect of kneecapping, quote, kneecapping Friedman's dictum, upending a half-century of business thought. Well, they were right. But they failed to note that that half-century since Friedman's article had been the most prosperous in human history, with unprecedented reductions in poverty and human suffering. But when Friedman wrote about the importance of profit, he was really just restating the very notion that led to 200 years of prosperity. Friedman didn't invent this. It had been going on for 200 years. So why did anybody listen to Fink? Well, because he is the CEO of BlackRock, he has tremendous, tremendous power. BlackRock is a financial monster, and a monster the public company CEOs in the United States cannot ignore. With its $10 trillion in assets under management, BlackRock has at least a 5% ownership, and it is the first, second, or third largest shareholder in 97.5% of the companies in the S&P 500. So nearly 100% of the 500 largest companies in America. So when Fink directs America's CEOs to turn their businesses from engines of economic production to drivers of progressive social policy, they had to at least listen. As a CEO in America, you ignore Larry Fink at your peril. Now, some of you who are attorneys or have worked on fiduciary duty issues may wonder, how could he do that? I mean, he's investing other people's money. How can he direct these companies in which he invests their monies for other people to focus on social issues rather than his clients' financial interests? Well, that's a good question. Even BlackRock has acknowledged that as an asset manager, it is a fiduciary duty. It is a fiduciary, and it owes a fiduciary duty that requires it to, quote, prioritize its client's financial interest. Remember that. The three key words here are client, prioritize, financial interest. This is, in your states, this is the teachers, the policemen, the firemen, the state employees that are the beneficiaries of the pension funds that your state has set up. BlackRock has an obligation to those clients to prioritize their financial interest. Now, Fink knew that this fiduciary duty thing was a problem when he drafted his 2018 letter. So how did he address it? Well, as some of you may know, BlackRock is an index or passive asset manager. So rather than recommending, what that means is rather than recommending investments in specific companies, BlackRock sells ETFs or mutual funds, their products, consisting of a group or an index of companies that represent a segment of the financial market based on shared attributes. That sounds complicated, but let's say it's the S&P 500. That's the 500 largest companies in America. That's their shared attribute. And by the way, the S&P 500 index is the most common index that's used, and it's BlackRock's largest product is based on the S&P 500 index. So when you look to the performance of BlackRock, you look to the performance of that product, which consists of 500 companies, not 10 or 20 or 50 companies that BlackRock picked out of the S&P. You're doing it based on shared attributes, not on an analysis of the performance of each company. And as a passive investor, BlackRock satisfies its fiduciary responsibility by selecting an index of stocks like the S&P 500, setting up a passive index fund, like an ETF, of the companies in that index, and having its clients invest, and then allowing each company in the index to succeed to the best of its individual ability, creating the greatest collective financial success for BlackRock's clients. If you invest in the S&P 500, you have the 500 CEOs of the 500 largest American companies trying to make a profit for you. I mean, this is an incredible power. BlackRock's role certainly wasn't to dictate strategic or operating policies to those CEOs or to any of the companies in the indexes it sets up in which BlackRock invests, based on BlackRock's management team sitting in their Manhattan offices deeming what is socially desirable. They were to set up an index, passively allow the companies in the index to perform, then call it passive. They call it passive investing for a reason. It's not because you're an activist. It's because you're passive. So how did BlackRock, a passive fund manager, become an activist investor that was now encouraging companies to go along with, or really compelling companies to prioritize these progressive socialist issues and political goals rather than its clients' financial interest? How could it do so and still be acting consistent with its fiduciary duty to prioritize its clients' financial interests? That is, again, the interest of some of your constituents. Well, it couldn't. I mean, Fink knew that. He knew he had to transform BlackRock's fiduciary duty to allow him to prioritize social issues over his clients' financial interests. And he considered himself up to the task. You know, with the logic that is somewhat difficult to follow, Fink claimed that investors' increasing use of index funds, they're very popular because they're very inexpensive, because you don't have to do a lot of research, and they track, they really track the American market and whatever market segment you're picking, and they're very successful. The returns are very good. But Fink claimed that popularity was driving, quote, a transformation in BlackRock's fiduciary responsibility. He claimed that fiduciary transformation was necessary because as a passive investor, BlackRock was unable to, quote, express its disapproval, close quote, with respect to underperforming company by selling the company's securities as long as the company was qualified to stay in the index. Well, of course, that was the case. He was a passive investor, right? You can't punish individual companies. That literally is the point of passive investing. An index fund manager creates a passive investment product based on an index rather than investing in individual companies, and then looks to the performance of the group. You can't take companies out of the group or stick different companies in, like, for example, the S&P 500. Again, not any particular company's performance within the group. A passive fund manager doesn't do the research an active fund manager does, or a stock picker, as you might call them, to select specific stocks in which to invest, which is why passive investment funds are so much cheaper. You don't do the research on every company. You don't monitor every company. And because you don't do the research, you really don't know what's best for each of the thousands of companies in which these financial monsters like BlackRock, State Street, and Vanguard invest. They're supposed to leave the strategic decisions to each company's board and operating decisions to the company's management team. Fink was arguing for think about this. He was arguing for a transformation of BlackRock's fiduciary responsibility. So BlackRock, as a passive investor, could be an active investor to set direction for the companies in which it passively invested. In other words, he was claiming that the success of index investing meant that fund managers had to abandon passive investing. The logic was circular, the irony was palpable, and the betrayal of BlackRock's clients was clear. But Fink had to do more than transform BlackRock into an activist investor to reorient all these American companies. He also had to transform the very law governing fiduciary responsibilities. He had to do it in two respects if he was going to actively compel companies to execute his policies. First, existing law governing fiduciary duties only protected BlackRock's clients. Remember the three words: client, prioritize, financial interest. So he had to expand it beyond his clients. Second, the law required BlackRock to prioritize the client's financial interest, not society's interest. This was protections for people that actually invested funds. So step one was expanding beyond its client base, the group to whom BlackRock owed a fiduciary duty. And the solution, you might have heard of this concept, it's called stakeholder capitalism. According to Fink, rather than just investors as traditional fiduciary duty required, the companies in which BlackRock invested must benefit all of their stakeholders, not just their shareholders, who were BlackRock's clients, but also employees, customers, and the communities in which the business operated. You know, when you owe a fiduciary duty to multiple groups, it's much easier to claim that your actions are in some other stakeholder's best interest or society's best interest, though perhaps not in the best interest of your clients. So this gave BlackRock wiggle room. But if BlackRock was now an activist investor that would no longer prioritize its clients' financial interests, what interest did it want companies to prioritize? Well, that leads us to step two, which is redefining what a fiduciary can do consistent with the scope of its duties that it owes to this new, broader stakeholder group. Now, Fink didn't want to be bogged down with any particular group of issues. He needed something broad and inclusive. So enters ESG. Fink left little doubt that ESG was to be every company's guiding light going forward. His letter stated, a company's ability to manage environmental, social, and governance matters demonstrates the leadership and governance that is so essential to growth, which is why we, BlackRock, are increasingly integrating these issues into our investment process. Of course, as I mentioned, there's no definition for what ESG includes. It simply includes whatever the left or Larry Fink wants it to include. So how would he accomplish this incredible transformation? Certainly no new laws were passed. You guys didn't pass any, authorizing the transformation of fiduciary duties. Wasn't a problem for Fink. For example, he is an unabashed advocate and crusader for the most radical environmental policies, such as the World Economic Forum's globalist net zero by 2050 policies. In his 2021 letter to America's CEOs, he literally stated that there is no company whose business model won't be profoundly affected by the transition to a net zero economy, which he said would require a transformation of the entire economy. Now understand, that is the goal. He wants to transform our entire economy. Fink said the quiet part out loud. The left is using climate change to transform our entire economy, and Fink is driving that change. Now, did any of you vote for Fink, empowering him to literally transform our entire economy? As that's what he intends to do. But how did Fink think he could personally transform our entire economy? Well, he wasn't shy about it. In Fink's own words, behaviors are going to have to change, and this is one thing we are asking companies here at BlackRock. You have to enforce behavior, and at BlackRock, we are forcing behavior. With his thumb on BlackRock's incredible proxy voting power, Fink believed he could simply force the policies he supported on our nation without the consent of the governed, let alone his investors, many of whom certainly disagree with his policies. How? Well, he would simply force American companies to literally transform the entire economy. And he wasn't bragging about what he could do, he actually was doing it. As some of you may recall, in that same year, 2021, Exxon, America's largest energy producer, an incredible, successful, and powerful company, tracing its roots back to John D. Rockefeller, was facing a challenge from a minor insurgent shareholder called Engine Number One that wanted to put environmentalists on Exxon's board. You know, people at first thought it was a joke, that Exxon's management reasonably opposed it and they would win. But to ensure that environmentalists were put on Exxon's board, BlackRock used its massive proxy voting power to support Engine Number One and voted against Exxon's profit-focused management team. As a result, environmentalists were elected to Exxon's board. And as absurd as it sounds, within less than a year, Exxon, our nation's largest and most profitable oil company, adopted a net zero carbon by 2050 policy. So America's preeminent oil company now supports severely reducing, if not eliminating, the very product that justifies its existence. And there you have ESG in a nutshell. Does anyone think destroying demand for Exxon's products prioritizes the financial interests of Exxon's investors, that is, BlackRock's clients? Obviously, it does not, but it did advance one of Fink's pet social goals, radical environmental policy. Now, fortunately, people noticed. More than anything else, this vote on Exxon woke people up, particularly red state governors, treasurers, attorney generals, and legislators such as yourselves. It was now patently obvious that asset managers such as BlackRock were successfully using their state's monies to advance progressive political issues. BlackRock couldn't advance at the ballot box because the issues lacked popular support. So beginning in 2021, red states started passing legislation to resist this ESG juggernaut, including 12 states that have restricted the use of ESG by requiring that asset managers focus on their traditional fiduciary duties to prioritize returns for the beneficiaries of the funds in their states, as opposed to BlackRock's and these other investment firms' personal, social, or political goals. We call it the fiduciary duty approach. It's on ALEC's website, and it's also the first issue mentioned in this booklet that Jonathan handed me just before I got up here, so it's 2024 Essential Policy Solutions. As I said, we call it the fiduciary duty approach. A lot of people worked on this. Heritage also has model legislation on this. I think ALEC, the ALEC bill is very good. The Heritage bill is good. They're very similar. So we've got model legislation out there. We've got states that have passed it. If your state hasn't passed it, please speak to someone at ALEC. Speak to Jonathan Williams or speak to me. This is extremely important legislation that strikes at the heart of the ESG threat. Now, some people have also passed what's called contracting legislation, which prohibits boycotting certain industries if they boycotting certain companies if they refuse to do business with the state, if they boycott an industry. That legislation is very important for dealing with ESG supporting companies such as banks and insurance companies. The fiduciary duty approach is what we're using for firms like BlackRock, because BlackRock actually doesn't boycott these energy companies. It invests in energy companies because they're in the S&P 500. So Exxon, Marathon, whatever company's in there, they invest. States have also withdrawn money from BlackRock. Basically, about $4.8 billion to date have been withdrawn from BlackRock because of its ESG policies. Now, because of these efforts, we've seen a momentum shift. In fact, the ESG resistance is now living in Larry Fink's head, and he seems stunned. Speaking at the Aspen Ideas Festival in June, Fink stated that he doesn't even use the word ESG anymore because it's been entirely weaponized. Our business was hurt. We lost $4 billion of mandates. I'm ashamed to be part of this conversation. But seriously, he's the guy that started the conversation. He's also proudly its lead advocate. Now even mentioning the acronym ESG creeps him out. But look, this isn't over. I mean, we've had a change in momentum thanks to that Exxon vote waking people up. But this is far from over. In fact, in that same meeting in June, Fink stated that while he no longer uses ESG, he believes in conscientious capitalism, which is really just ESG in sheep's clothing. As I said before, people figure out what they're doing, they just change the name, and they think nobody's going to notice. Now, this is a generational fight. This is a fight where we all need to stand up. And some of you may be reluctant to enter the fray, concerned about the risks that you might offend. I mean, politicians out there, you don't want to offend anybody, and I certainly understand that. Business people feel the same way. So let me leave you with some words from Ronald Reagan in a 1977 speech on the collectivist threat of his time at Hillsdale College. He addressed the reluctance of some business people to stand up to the collectivists of his time, saying, "If some among you fear taking a stand because you're afraid of reprisals from customers, clients, or government, recognize you are just feeding the crocodile, hoping he eats you last. As the guardians of your constituents' interests and defenders of our republic, you stand at the forefront of this fight. It's so important that you take up the mantle. This is your time. This is your fight. You cannot rest, you cannot waver, you cannot retreat. if we're to pass the freedoms and prosperity we inherited onto that generation of kids that were in the video we saw earlier. May God bless each one of you. May God bless ALEC, and may God bless the United States of America. Thank you.